In 2010, an entire European country ran out of money. Not a company, not a bank, a country. Greece owed more than €300 billion more than its entire economy could produce in a year. Investors around the world were betting it would collapse. Banks froze. Borrowing costs exploded. The fear spread beyond Athens. Because this wasn't just about Greece. If Greece failed, could the euro be next? How does a modern European nation, a member of the European Union, end up on the brink of bankruptcy? The answer didn't begin in 2010. It began nearly a decade earlier. In 2001, Greece adopted the euro. Joining the eurozone changed everything. Suddenly, Greece had access to cheap borrowing. Interest rates dropped dramatically. Investors assumed that being tied to powerful economies like Germany and France meant safety. Money flooded in. The government borrowed heavily. Public sector wages rose. Pensions expanded. Infrastructure projects accelerated, including the massive 2004 Athens Olympics. On the surface, Greece looked like a success story. Consumption boomed. Jobs increased. Living standards improved. But beneath the surface, something fragile was forming. Greece wasn't producing enough to sustain the spending. Tax collection was weak. Public payrolls grew larger. Structural reforms were postponed. Instead of fixing deep economic inefficiencies, leaders borrowed to cover them. And then there was something even more dangerous. The numbers weren't entirely honest. For years, budget deficits were underreported. Debt levels were higher than publicly disclosed. Investors believed they were lending to a stable economy. They weren't. Then came 2008. The global financial crisis shook the world. Credit tightened. Investors became cautious. Suddenly, countries with heavy debt were no longer seen as safe. In 2009, Greece revealed the true size of its deficit. It wasn't small. It was massive. Confidence shattered almost overnight. Borrowing costs surged. Markets panicked. Investors demanded higher interest rates to compensate for the risk. Greece couldn't refinance its debt. And when a country can't borrow, it runs out of options. By 2010, Greece officially requested a bailout. The European Union and the International Monetary Fund stepped in with emergency loans, but those loans came with strict conditions. Austerity, spending cuts, tax increases, pension reductions, public sector layoffs. The goal was to restore confidence. The result was social upheaval. Unemployment soared above 25%. Youth unemployment climbed even higher. Businesses closed. Protests erupted in the streets of Athens. Trust in political institutions eroded. For many citizens, the crisis wasn't about bond yields or deficit ratios. It was about survival. And the fear didn't stop at Greece's borders. Investors began questioning other heavily indebted countries: Spain, Portugal, Italy. If one Eurozone country could collapse, was the entire system vulnerable? For a moment, the euro itself seemed fragile. The crisis exposed a fundamental flaw: countries sharing a currency without sharing unified fiscal control. Eventually, through multiple bailouts, debt restructuring, and years of painful reforms, Greece stabilized. But the damage lingered. The economy shrank by more than 25%. An entire generation faced lost opportunities. And the illusion that advanced economies were immune to sovereign collapse was gone. The Greek debt crisis wasn't just about overspending. It was about easy money, hidden weaknesses, misplaced trust, and a system built on confidence. When confidence disappears, even nations can fall. And that raises a question far bigger than Greece. In a world still driven by debt, could it happen again? This is Nito D Creator. Follow for more.